Good day everyone and welcome to another Tokenomics Academy class of the ValorizeDAO, and today we will be talking about staking of crypto assets. So what are the objectives of this class? Well, we want to understand the basic concept of staking of crypto assets. We want to cover the different incentives behind staking for different parties such as investors, networks and DeFi platforms. Want to be aware of key staking platforms and also their staking models, the trade-offs that come along with it, and also we want to cover some of the risks that are associated with staking. So first of all, what is staking? Staking is the process of locking up crypto assets for a certain amount of time in order to receive rewards or earn interest. While in traditional finance, you can see this as keeping your money in the bank to earn interest or receive dividend payouts from stocks. So what are the three main parties that are involved in staking? Well, of course, in the middle we have the investor, and the investor can earn fee-based or emission-based yields from DeFi platforms. It can provide collateral to earn rewards, and it can become a validator to earn rewards. So the fees are often associated, or the yields are often associated with DeFi platforms. So the DeFi platform wants people to stake to reduce the token velocity and to provide liquidity to liquidity pools. Well, providing liquidity is actually staking more than one asset. And of course, DeFi platforms want people to stake because more participants is associated with more revenue from fees. Then on the other hand, we have the network, and when investors stake the network's cryptocurrency, they can increase security of nodes and network, and also it can become a validator and increase the decentralization, which we're all going to cover in the next couple of slides, starting with the relationship between investor and network. So in this case, of course, the blockchain. So as I already said, you can become a node or a validator, and that is often the case in proof of stake blockchains such as Solana, Binance, Cardano, and of course when ETH transitions to ETH 2.0. Then also what can happen is you can stake your cryptocurrency to secure the network or the services that is provided by the network. And in this case, we will talk about Chainlink, which provides Oracle services. So to summarize this relationship, we have an investor, and that investor can become a validator or a security provider, and the network will reward that investor mainly with the native cryptocurrency. So how to become a validator in a proof of stake network? Well, we already covered this in a previous class where we talked about the transition from ETH 1.0 to ETH 2.0, and a validator is a node that has a stake in a network, often in the form of the native cryptocurrency. For ETH, you need to stake, for ETH 2.0, you need to stake at least 32 ETH, and for Chainlink, you need to stake at least 1,000 link, and then you will become a network validator. And during the normal operations of a blockchain, one validator is randomly chosen to propose a block to be mined. Then that proposed block is validated by the committee, and once validated, the proposer that receives the rewards, and the block is mined. And then this operation is, or this process is repeated. So this is very simple. You stake your crypto asset, and you get rewards as part of being part of the validating of the network transactions. Then the other topic I want to talk about is providing security or increased security by staking your crypto asset. And if we look at Chainlink, we can do two things by staking your Chainlink. Well, you can run your own node, as we already discussed in the previous slide, or you can stake Link to increase the security of the Oracle service that the nodes are providing. And both will receive both options will receive payment in Chainlink. So here to schematically depict, we have this. You can become a validator, so we have this mini network, and you can execute the smart contracts. But the Chainlink nodes are valued by the amount of Chainlink that's being put up as collateral. So what you can see this as a service level guarantee, and that is payment to assure correct execution of smart contracts. In this case, you just stake your Chainlink, and the more Chainlink is staked, for a node that actually performs those Oracle services, the more likely that this node will be the source of for completing large transactions. So those large transactions are important because, well, that's part of the Oracle service, but also why it is important to have increased security is because the Oracle service itself is important to the functionality of the Ethereum network, which is where Chainlink is built upon. So Chainlink has hybrid smart contracts, and with hybrid smart contract, we mean that it can take out external information, and that information can be used in the blockchain. So it's very important for a lot of functionalities of Ethereum blockchain, and it's therefore important to, besides staking your Chainlink to become a validator, it's also important to stake your Chainlink to for the service level guarantee of the nodes that perform the Oracle services in Chainlink. So now I want to switch to the relationship between the DeFi platforms and the investor. So investors provide reduced token velocity. Well, we already discussed this in a previous Tokenomics Academy class, but to refresh your memory, we can we'll summarize it like this. A high token velocity is associated with a lower unit price of the token when supply and total economic output are constant. Well, if you do not remember that formula correctly, it's very simple. We have the token supply, and the token supply, of course, that's a term we're all familiar with, and then we have the total economic output. And total economic output is, well, the market cap. And the token velocity plays an important role in determining the price of, or actually the price pressure may be upward or downward. So the token velocity plays a very important role. So if there's a high token velocity, this is associated with a lower unit or with downward price pressure. When we look at lowering the token velocity by staking or locking up tokens, this might favor upwards token price action. So I'm not going too much into this. If you want to know more, I would like to refer you to the 6th tokenomics class that we held, as Javi explained very well this went very deep into this topic. Then, besides reducing the token velocity, the investors provide liquidity, and the DeFi platforms for staking your tokens by locking them up or by providing liquidity. This will once again result in the investor receiving rewards. So before we're going into some of the key platforms we are interested in, I want to cover some definitions. So you might have encountered this already if you have been staking your crypto assets, such as annual percentage rate, annual percentage yield, the total return, and these terms as dividend and token dividend and clean yield might be a little bit new to you. So starting with annual percentage rate, this is defined by the periodical interest rate times the number of periods. It's fine if you do not understand that directly, as we will cover APR and APY abundantly in the next slide. Then we have the annual percentage yield, which is defined by the compounded interest per year. We have a dividend, also known as fees, which is an important term to remember, which is a dividend distributed in the form of cash. So we can see it as cash dividend. Then on the other hand, we have stock or token dividend, also known as emission, and it's defined as the dividend distributed in the form of tokens or stock, depending on if you're talking about a crypto asset or a stock. And then, of course, as you're investing, you want to know your total return, which you can calculate by the yield plus the change in asset price. And last term I want to cover in this slide is clean yield, and that is defined by the fact that the yield needs to be paid out in a different token than the underlying investment to be considered clean yield. So starting with difference between APR and APY, let's say we have an initial amount of $10,000. For the annual percentage yield can be calculated using this formula, which is 1 plus the periodic rate to the power of the number of periods per year. So what APY actually stands for, it's just the flat interest you receive on top of your initial amount after 1 year. So this annual percentage yield factors in how often the periodic rate is applied, which can be daily, weekly, or monthly. So it's quite simple. If you have an APY of 5%, you get 5% on top of your initial investment. Then the annual percentage rate is slightly more complex. So we have the periodic rate times the number of periods per year. If the APR is 5% and the interest is applied once a year, you will get the 10,500 at the end of the year. However, if it is applied monthly, then the 5% is divided by 12. So then the periodic rate has changed to 12. The number of periods per year has changed to 12, and then periodic rate is the 5%, because if we have this formula, we have 5% here, we have the number of periods here, that is 12, and then we can calculate the periodic rate, which in this case is approximately 0.42%. And if we calculate what our return will be per number of periods after 1 year, so to determine the APY, we have the 0 plus of the 1 plus 0.42%, which gives us this number, to the power of 12, which is the number of periods per year, and that we do that times the initial investment, and then we get, after 12 months, $10,515.8. So why is this? So how is this different than APY? Well, what happens after each month, this 0.42% has been added, or will be added to the initial investment. So after 1 month, you get 10,042 euros or dollars. After 2 months, you get 10,084. So it compounds over time, and then after 12 months, you get 10,515.8. So if you have an APR of 5%, but we have 12 number of periods per year, then your APY will be 5.15%. So because there is compounding of that periodic rate for each period, the APY will always be higher than the APR. Alright, so the next DeFi platforms we want to discuss, now that we know about APR, APY, the different kind of dividends, we can extensively talk about some of these key platforms. So we have Curve Finance, which is on the Ethereum blockchain. We have Wonderland on the Avalanche blockchain, and we have VBS Finance on the Kronos blockchain, which is the Crypto.com blockchain. So starting with Curve, well, Curve Finance is actually generated or created by CurveDAO, and CurveDAO has a token called CRV. They have a decentralized exchange called Curve Finance. It's well known for its pegged asset swaps that have high liquidity and low slippage or fees, and it's well known for the tri-pool, which is the most capital efficient route for swapping USDT, USDC, and DAI. And if I remember correctly, they have around 3.4 billion liquidity in this pool. And if you provide liquidity for one of the pools in Curve Finance, you will receive CRV as a reward for providing liquidity, which is important to remember, as we will cover that in the next couple of slides. So what can you actually do with CRV? Well, when you have CRV, you can stake that in the platform to receive something called Vote Escrow CRV, abbreviated as VECRV. This can be done, you can lock it up for at least 1 week or up to 4 years, and the longer the lockup period, the more VECRV is received. So when you stake that CRV, receive VECRV, there are 3 things you can do, with the first one being passively, because of course the Curve Finance has this business model where they earn trading fees. So if a lot of trades happen on the platform, the fees need to be paid, and that is part of the revenue of CurveDAO or of the platform. And as a reward for people that are staking VECRV, 50% of all trading fees are distributed to those holders in the form of tri-pool LP tokens. So you don't get CRV as a reward, you get tri-pool LP tokens. And of course, you can exchange those for USDT, USDC, or DAI. Then on the other hand, you can also boost your liquidity pool rewards that, as I said before, if you provide liquidity, you get CRV rewards, and you can boost the liquidity pools you're interested in, or where you're actually probably providing liquidity to as well. So there's a lot of incentives with staking your VECRV, and also by providing liquidity based on the Curve Finance model. And the last thing you can do with VECRV is to vote for proposals of the decentralized autonomous organization, but also you can vote on the weighted pool gauge for liquidity pools. And I thought the latter was interesting, so that is something I want to cover in this slide. So we have the weighted pool gauge, and to refresh your memory, if you provide liquidity, you receive CRV as a reward. When you're staking your CRV, so when you have VECRV, holders can vote on how those CRV rewards are distributed across the pools of liquidity pools of Curve Finance by assigning weight to the pool gauge. So what you can do, you just vote for which pool should receive the most CRV as a reward. And this is depicted as this distribution. All of this will make up to 100% of the CRV that is then distributed to all the liquidity providers. So now I want to talk about a different project called Wonderland, and you might be familiar with it as it's a very high APY staking platform. So why is this interesting? Well, the current annual percentage yield is 75,725.9%. So how is this generated? Well, we have two parties. We have the minting party and we have the staking party. And when you buy time, you can stake it, and for each time you get one memo, which stands for memory, which is part of the Wonderland theme. And with each rebase, which will happen automatically, your Memo balance will increase. And how is this done? Well, you have minters, and minters sell LP tokens or reserve currencies or reserve crypto assets, and by selling those, they can mint time. Well, how that benefits them, I'm not going to talk about that. But with all that time that's being minted, at least a large portion of it will be redistributed to the holders of, or to the stakers of time, so the holders of Memo. And that's also something we call emission, because it's stock or token dividend. You get more of the asset you invested in, which is in this case Memo. And because of this, because you can exchange the Memo back into time, there will be this increase in supply, of course, in time. And this increase in supply will eventually result in downwards price pressure for the time token. We'll talk about that in the next couple of slides. Why this, not necessarily why this is a bad or good project, but later on we will talk about how we can consider this type of yield, and this might help in making decisions for investing. It's not financial advice, but it's just to make you aware of how to differentiate between the type of yields that each kind of staking platform is providing. Then the last project I want to discuss is called Very, Very Simple Finance. And we have two tokens, the VVS token, it's a native utility and governance token. And the XVVS token is a yield-bearing governance token. And this can only be obtained through staking of VVS, and this XVVS can be locked up in a vault for up to 4 years. So this VVS token has quite a high token velocity, so it has quite this downward price pressure, also because the supply is continuously increased because of all the staking options that we're going to talk about. But for example, with the Blink swap, we have VVS is an interesting project because it has this algorithm that obtains the best swap price for a pair, and it looks through several liquidity pools. And of that pair, the VVS is often one of those tokens. So there's a lot of swapping going on, which results in high token velocity, and that's why the XVVS token is quite important, as it will reduce the token velocity. And some other features that will further reduce token velocity is, of course, staking of LP tokens, with one of them often being VVS. And what you can receive is high yield returns in the form of VVS tokens. So you stake VVS, but then there's still more VVS brought into circulation. Then we have the glitter mines, where you can stake VVS, and then you also receive more VVS, which is very low yield, or other tokens, but that's only for a limited time. And this is all associated, so the other tokens are often associated with initial gem offering. So VVS, besides being a DeFi platform, it's also a launch pad for key projects, at least what they think. are key projects. So to enter this initial gem offering, you have to stake LP tokens and you have to lock up a certain amount of XVVS for a certain amount of time. And if you do that, then you can invest in new projects that are provided on VBS Finance. So now one more technical slide to make you aware of what we can consider clean yield or, well, not clean yield. So we have, as already discussed before, we have Wonderland that has a very high APY. It is mainly emission, which is the dividend in the form of stock or tokens, of course, this case tokens, that when you invest in the stock market, you might be familiar with the word dilution. So in other words, that's increased supply of the tokens. So if we have this formula, when the market cap stays the same and the supply increases, of course, the price goes down. Then if we look at the yield, you have the price of the asset, then you have, after some time, you have received dividend in the form of tokens, and if you divide that by the invested amount times 100, you get the yield. But because of the increase in supply, you get this downwards price pressure of the asset, and of course also the yield will go down. So with that in mind, if we look at Curve Finance, that the APY of staking your CRV, receiving VE CRV, and passively receive a portion of the fees that have been collected through the platform, that APY is 3%. So you get 3% on top of your initial investment, where that you stake to receive VE CRV, and the fees, that the 3% is made up of triple LP tokens, which you can exchange for USDC, USDT, or DAI. And this is considered clean yield. And this is considered clean yield because you receive rewards, or in this case, yield or fees, in the form of, well, cash dividend, actually, because you can just exchange those tokens for a stable coin, which we can consider cash at the moment. So you can, that's why it is considered yield, because you receive rewards that are not in the form of your initial investment, which are staked CRV, or yeah, the VE CRV that you receive from staking CRV. So that's why it's considered clean yield, and Wonderland is just emission-based rewards and is not considered clean yield because you get only more of the same token. And more of the same token means increased supply, downwards price pressure, lower yield. But then, why would people invest in Wonderland? Well, there's one, I'm not sure if it's a rumor or actual plan of Wonderland DAO, but what they might do in the future is actually stop with this high APY and stop with this increase in supply or this continuous dilution. And if that happens, when you have collected a lot of time, then, or time tokens, then all the actions that come afterward, because the continuous dilution has stopped, all the actions that come afterwards to increase the market cap will of course increase the price, because the supply is not being increased anymore as much or at all, depending on what choice they make. So that's why people want to collect a lot of time, even though the price might go down. It might, the dilution might stop, and they might see some upwards price movement later down the road. So that's not saying that clean yield is very good yield, but this is to make you aware that there might be a different reason why people are investing in projects with a high APY than something with a low APY. But just to make you aware of the difference that comes, the different yields that you can receive. Then the last topic I want to discuss are the risks of staking. So some protocols or platforms that are struggling or failed. One of them is Anchor Protocol. Well, we all are aware of the death spiral that occurred in the Luna network that we discussed in one of the previous tokenomics classes. And Anchor Protocol is the DeFi platform on top of that network. Then we have Voyager, which loaned out 650 million to a hedge fund called 3 Hours Capital. 3 Hours Capital over leveraged and had to file bankruptcy. So Voyager does not receive their money or the interest or the money loaned out. So they are struggling. And of course, Celsius had imaginary DeFi yields. Seems to look like a bit of a Ponzi scheme with those yields. But also what happened is the loss of the peg between ETH and ST-ETH. So if you stake your ETH, you would receive staked ETH. But staked ETH should be pegged to ETH. And that peg was lost, unfortunately. So that's also why Celsius is struggling. And so to summarize the reasons, well, insolvency, not being able to pay back your debt, not maintaining those yields, and those peg was in the case of Celsius, and insolvency for Voyager. And of course, a reason for failure is exploited protocol vulnerabilities, which happened to UST and Luna, and over-leveraging by hedge funds that are involved in crypto. And consequences are bankruptcy and freezing of withdrawals, which of course is a nightmare. Is a nightmare of every investor. So some key takeaway messages. Staking. When we talk about the word staking, it can involve blockchain networks and DeFi platforms. So it doesn't involve just one specific platform. It involves just it's more than that. So I want to be sure that you differentiate between the blockchain networks and the DeFi platforms, and also the differentiation between fee-based yields and emission-based yields is very important to become knowledgeable in how and where to stake your assets. Once again, not financial advice. So I hope you can say to yourself that you actually understand the basic concept of staking of crypto assets, that you understand the different incentives, that you are aware of the staking models and the trade-offs and the different platforms, or some important platforms, and also that you're aware of the risks. Thanks for tuning into the Tokenomics Academy of ValorizeDAO. Please like, subscribe, and hit the notification button for more tokenomics content. And see you at the next one.